Coming up on today's show, stocks finish higher on the back of the jobs report that came in a bit hotter than expected, along with spiking consumer sentiment, which reinforces the soft landing narrative and sending treasury yields back up, plus all the latest on bonds, commodities and cryptos, and the S&P 500 breaking out to new year-to-date highs. Hey, welcome back everybody to the Click Capital Daily Market Show. Thanks very much for tuning in, and another interesting day on Wall Street with jobs data coming in a bit better than expected, along with consumer sentiment survey, helping to reinforce the soft landing narrative and keeping the stock market in that Goldilocks scenario, which is really helping growth stocks. As we saw today, led by semis again, with most of the tech space having a good day, and we got a bit of a bounce back in the energy, oil and gas names with crude ticking back up, and there's a bit of a growth rotation out of defensive names, including utilities as well. And there we have it. The S&P 500 got up to 46.09 today, just a few points above the prior year-to-date high at 46.07 back in late July. And it looks like we're pretty much close to confirming the break of that bearish engulfing pattern we got back then, which kicked off an almost 500-point fall over the next couple of months, where we quickly found a bottom and have pretty much just bounced up in a straight line since then. The market had been coiling up for the last 2 weeks, and it looks possible here we could be unwinding on the upside. However, this could still turn into a head fake, potentially a bull trap. But stick with me because I'll come back onto the charts later and I'll show you some other things that I've found out there. The biggest piece of news today was the jobs data, which we get on the first Friday of every month. It's one of the most important pieces of economic data, as the jobs market has a huge effect on the economy. And the US economy added just under 200,000 new jobs in November, and that was against the forecast of 180,000, so pretty good beat there. Helping that was employment in leisure and hospitality surging by 40,000. Retail actually saw a decline of 38,000. And the end of the United Auto Workers strike also led to a bit of a bump in manufacturing employment. The unemployment rate was also expected to come in at 3.9%. It too came in better than expected, 3.7%. And even though it was better than expectations, still doesn't mean the economy's going into full-on expansion mode again. Because even though we beat coming into 199,000 new jobs, that's still below the average monthly gain of 240,000. Over the prior 12 months. And payroll gains are becoming more concentrated, mainly in government and healthcare, and they're sectors that are largely insulated from the effects of higher interest rates. And so the jobs market is still softening. There is still a downtrend. It's just not always linear. We don't always move in one step forward. There is a few bumps up and down in the data month to month. However, nonetheless, it does reinforce the soft landing narrative that markets have come to hang their hat onto. And this should have the Fed very pleased with just a softening in the economy, inflation coming down, and could very well allow them to lower interest rates next year without anything massive breaking. And so this is suggesting to markets that there might be a bit less recession risk out there than many have thought. And so whilst things look good now, and there is still technically the possibility of a soft landing, they have happened before. Looking back in history, over the last 60 years, on 9 different occasions when the Fed has raised rates to combat inflation, 8 of those times has resulted in a recession. And you got to remember, this is the worst inflation we've had since the 1970s. So looking back in history and at yield curve indicators as well, there's still a good 80-90% chance that we could see that recession next year. And most of the time it does come on very quickly out of nowhere and catch a lot of people by surprise. And that's the situation we could be setting up for. Stock market could still rally for another couple of months. And then just like a big building wave, it could hit that crescendo point all of a sudden and things come crashing down. But for now, bulls do have a lot to hang their hat on, including a much better than expected consumer sentiment survey today, driven largely by easing concerns around inflation. That's the University of Michigan's Consumer Sentiment Index, coming in at a robust 69.4. That's up from November's 61.3 and well above forecasts of 61.6. And we saw that in some pretty good Black Friday and Cyber Monday sales, although a lot of it's been driven by credit and pay later options. The lower price of gas is helping consumers to feel better, and they're still out there and spending. And so stronger than expected economic data. Got treasury yields climbing back up today. And we've got the last Fed meeting of the year on Wednesday next week. And I would expect Jay Powell to come out and probably lean more to the hawkish side, as I think he'd like to cool risk assets here at yearly highs and get those yields and rates back up so the bond market can keep doing the job for him and just gently cool the economy down without anything major breaking, and him having to raise rates again, which could come with a lot of risk. And even though we got a bump up in Treasury yields today, Fed Fund futures still think the Fed is pretty much done here, even though they dropped their chances of the Fed cutting rates in January and March now to about 44-45% and just kind of pushed those rate cuts out a bit today. And we did get a pretty nice move up in government bond yields today. Got the 2-year climbing 12 basis points, its biggest one-day gain in many months. 5-year adding 10 basis points, and a little bit less in the back end, 10-year adding 7 basis points. So that's basically the bond market saying the Fed could stay a little bit higher for longer, as we see in the short-dated stuff climbing more, but still not sure on the economy's strength. That's why we didn't see a big jump in the 10-year. However, we may just have found support here with these reversal signals of mine as well on the 10-year, because like I said on Wednesday, I would not be surprised at all to see Jay come out a bit hawkish and once again trying to convince the market he's leaving the window open for another hike. He's going to stay higher for longer. They're not going to cut anytime soon, because I don't think he wants to see the 10-year go below 4%. Same with the short durations, as that could likely create a scenario where inflation could uptick again if financial conditions keep loosening, whilst we've got risk assets ripping to year-to-date highs. And with that price momentum, we've got Wall Street bulls out in force. Like FundStrat's Tom Lee, stocks are taking off on a liquidity rally and will rocket to new highs next year. He's got a target of 5,200 on the S&P, saying the Fed is no longer fighting an inflation war, but really shifting towards managing the business cycle. And he could be right, because investors did take $420 billion out of stocks this year, sending money market funds to record levels. It's a lot of dry powder to come back in the stock market, and with yields pulling back this last month or so, some of that money is probably finding its way back into the stock market, and we can see that with cyclical stocks, bank stocks, and small cap stocks, which are pretty sensitive to the economic cycle. They've been rallying up pretty good these last couple of weeks. And since for most of this year, it's really been a story of the mega cap 7, really leading the indices higher and outperforming the rest of the market by record margins. Citigroup may be right that the stock market may broaden, especially if we keep seeing improving earnings growth, which is possible if a lot of people are employed. There's a lot of discretionary money out there to be spent. And we are continuing to see technical signals that this rally should go further into next year, coming in the form of breadth thrusts. As noted by Carson Group Chief Market Strategist Ryan Detrick, we continue to expect stocks to do quite well, and we remain overweight equities, saying they just got an extremely rare signal that on Thursday more than 60% of all components of the S&P 500 hit a new 20-day high, which is a very rare breadth thrust and suggested many stocks were surging, which tends to be a signal of impending strength. That shows a lot of buying has taken place recently, not just in a few large stocks. And since 1972, this rare signal has flashed 15 times, and 100% of the time the S&P 500 was higher a year later with an average return of 18%. And like I've been saying for the last month or so, that could mean we see a really good catch-up trade in the form of small caps and potentially small cap tech stocks, as small caps have underperformed the main indices for a couple of years now, getting down to record multi-decade lows, especially when measured on valuation metrics as well. And just looking at the daily chart of the Russell 2000 ETF does look pretty bullish there. These big volume and volatility thrusts higher and then coiling back up, and we look to be ticking really higher here. And there's a look at the daily chart of the spread between the Russell 2000 and the S&P 500 small caps versus large caps, and that may have found a bottom back in mid-November. We can see over the last month small caps have outperformed large caps, and just taking you out to a monthly chart on this spread, you can see the lows it just got down to, not seen since the start of the millennium. And so if this stock market rally was to broaden out and the economy keeps chugging along, then small caps could have a good chance of outperforming large caps next year. And that's even if the trend of unemployment does keep rising. Because looking back in prior cycles, small caps often start to outperform large caps around the time unemployment starts to rise. And this is a chart of the Russell 2000 against the S&P 500, just the same as the chart I was just showing you. In the dark blue, that's the spread outperforming, and in the light blue, that's unemployment. And so in times when unemployment rises, it's a bit counterintuitive, but small caps actually a lot of the time outperform large caps. Not only that, but we've got record spread between the valuation of small cap value and large cap growth. In fact, the current spread has only been seen less than 1.7% of the time, and in the following 10-year periods, small cap value returned a huge 16.8% a year more than large cap growth. So like I've been saying for a little while now, I'm bullish on small caps going forward, and there's still a lot of great stocks out there. You can find PE under 10, dividend yield above 5%, and there's still plenty of good value just outside those magnificent 7 stocks. However, not everybody's so sure, and that includes Jim Rogers, longtime market player, former business partner of George Soros, and he says stocks, bonds, and real estate are all bubbles set to pop, and that a harsh recession recession is on the horizon. He only believes the debt-laden US economy is headed for disaster, and he's heavily invested in dollars and commodities, and this is something he's been talking about for a while. Going on to say he's not bearish on the US, he's just not invested there and waiting to sell it short. He expects things to go bad in the US before long, noting that the US economy has had the longest period of expansion without a recession in recorded history, and it's coming to an end. Going on to say you see inflation going higher, interest rates going higher, some stocks go up every day, some bubble stocks, you see all the classic signs that this is nearing the end. And his favorite spot of markets, and one he says is the only one that is still historically cheap, are commodities. And that is one point I do agree with him on, because when you look at a spread of commodities versus S&P 500, they are still near record lows, even lower than the dot-com bubble. And if we do get a decade of structurally higher than average inflation like back in the 70s, then commodities significantly outperform stocks, or at least it makes a good hedge if that were to occur. And I've been bullish on commodities for a couple of years now. I've had my entire pension fund invested in an Australian commodity stock ETF for a while now, and I plan on sticking with that for some time, likely into the 2030s, until this spread at least goes back above average. And on that ETF, I'm earning over 5.5% dividend yield, which makes for a great snowball compounder over time. And I plan on just adding to the pension fund every time commodities take a good dip. And just staying on commodities, the theme in the oil market the last couple of weeks has been OPEC and the Saudis and Russians losing their grip. They've tried to get underneath it and talk it higher, which traders have pretty much just ignored, and that's thanks to booming US supply and the perception that demand was coming down. There is for sure weakness in the Chinese and Eurozone economies. However, with that stronger than expected economic data coming out from the States today, market adjusted its tune a little bit on that demand destruction theme, and crude oil futures actually finished up 2.7% today, and maybe trying to defend this $70 level here, because the US consumer is still the biggest buyer of oil. And if things are looking good going into the holiday spending season and the pullback in gas, Americans may just travel a bit more and buy a bit more goods and services, and that could be supportive of the oil futures, and that could also get oil swinging back towards that $80 a barrel level as well. We also got gold pulling back this week after hitting all-time highs last Friday. That's on the back of the better than expected US jobs data, which got yields and the dollar ticking back up, and that's something gold had been liking, a weaker dollar and falling yields. And even though we're having a bit of a short-term pullback now, gold still could be a good investment for years to come. And like I said before, at least make a good hedge for inflation, like the 1970s when gold ripped up in a huge bull market when stocks went nowhere for a decade. And just looking at the daily chart of gold futures, dipped down today to $2,010 an ounce. I'd say right now that $2,000 level is not going to hold, and we're going to go below that next week. I'll just be looking for signs of dip buying and support, maybe around the 1960 to 1950 level, where we last had a little bit of a swing low there. But one thing's for sure, it's been a much better place to hide out and find safety versus treasuries over the last couple of years, because this is a monthly chart on gold versus TLT, and since the start of 2020, it has increased more than 100% the spread of gold versus long-dated treasuries. And after the latest conflict in the Middle East kicked off, that spread shot up 14% in 1 month, but the last 2 months we've pulled back a bit here, as we've had a good bounce in the bond market, and gold has stalled out a bit at all-time highs as well. Over to economic data, that GDP growth out of Japan actually came in a lot worse than expected. Annualized down 2.9%, that's kind of recession territory. And there's the state's employment data coming in better than expected, with average hourly earnings a bit better than expected, and that Michigan Consumer Sentiment Survey blasting through expectations, showing consumers are feeling good. And I'd say that big pullback for the price we're all paying for gas is helping things quite a bit going into the holiday season. It's no surprise that the fear and greed index is staying elevated in the greed zone, and a bit of a pullback in corporate insiders selling, but still a bit significant relative to purchases. And my institutional buying percentage indicator still in the neutral zone, 47%. Still not sure whether this is a top or not, but we are getting that divergence on the S&P 500 oscillator, starting to move away from price a bit there. And then just looking at my regular chart, like I've been thinking, the market's going to come up and test these year-to-date highs, which it did today. It's just kind of drifting and grinding there with no real sharp direction and really low volatility. And we can see that on the VIX, having a classic Friday volatility crush, now down to a super low 12.3. Option dealers pretty much saying there's no risk out there in the world. Everything is A-OK. We can see that with a little bit of a drop in their volatility risk premium today as well. A little bit of a turn down on bond market volatility, but still really elevated relative to stocks. And look at that put call ratio in equities, 0.69. People loading into calls, not worried at all, not buying insurance. And we can see that in today's option market activity, 40 million contracts traded, huge 57% of them calls. And 65% of those options are expiring in 5 days or less. So basically a lot of people betting the market is going to keep going up next week. week. But we do have quadruple witching next Friday, the third Friday of December, the end of the quarter. It's basically when we've got not only stock options, stock index futures, stock index options, stock futures, all expiring. Things can get a little spicy on quad witching days, a lot of volume, especially going into the weekend and into Christmas. People trying to wrap things up for the year, get better positioned, maybe doing a little bit of tax loss harvesting, positioning for the new year, and just looking at max pain on the SPY. That is quite a bit lower at 440. Here we are on the SPY, 440s down here. So that would be about a 4% pullback in the market for max pain to hit next Friday, which I think the market would need some sort of shock or surprise to get there, because the way things are going now, we're just kind of grinding higher in this low volatility environment. Max pain isn't always achieved. It is kind of a bit of a magnet. But if we did get that type of move, I think that would catch a lot of people off guard, because like I said, the market's positioned bullish now. Everyone's kind of jumping on this, and there is a lot of obvious signs that stocks should go higher. So it is the consensus, and the consensus is not always wrong. However, when it is wrong, it can be wrong quite a nasty fashion. But we're coming out of Q3 earnings season. We don't really have too much in the way of big economic data next week. So like I said, it would take a bit of a shock for that to happen. Also got international stock markets finishing the week on a higher note, except for China. All other markets are kind of going sideways, if not ticking a little higher. Still got some good breadth out there. 82% of stocks above their 50-day average and really staying elevated. Same above the long-term average, 62% of stocks. And some healthy readings and new highs versus new lows as well. With the growth versus defensive sector spread breaking out again today to highs, along with that growth rotation we can see in high beta stocks versus low volatility. But we've still got the Russell 2000 outperforming NASDAQ stocks in the last week, along with large caps and SPY having a pretty good week. There's discretionary stocks breaking out against staples in a sign of economic expansion, and a bit of a tick up in the copper versus gold spread. Market kind of thinking today, maybe the US consumer isn't going to get that weak all of a sudden, and we're not going to see that demand destruction for commodities. And we can see that with a little bit of a breakout in high yield bonds versus treasuries, but we did get a bit of a tick up in inflation expectations because of that as well. And as you'd expect, a little bit of a pullback in TLT with those high bond yields, but that is coming from a position of technically overbought. We can see my reversal signals firing off there. But just like high yield bonds, still in a well-defined short-term uptrend, as we can see in the wave flow here. And a bit of a tick up in the dollar, just under 104. Didn't seem to hurt Bitcoin too much. Still actually traded up to year-to-date highs today, just getting close to 45,000. We are a bit technically overbought. We don't have too much huge divergences here, just a little stretched here compared to the averages. But being Bitcoin, this could still rip from here, getting up to 46, 47,000. Over the weekend into next week. Over to stock sectors, the winner today is the pointy end of the market. Meme stocks up 2.45%. Similar space, ARK Innovation up 1.84%. And again, the IPO sector coming in third at 1.33%. Losing sector today was the gold miners, followed by biotech coming out of a bit of an overbought position as well, and a little bit of a pullback in the cannabis ETF, which is normally very volatile anyway. And those yields moving back up. Got REITs pulling back a little bit, and strong economic data. A bit of move out of the defensives. We can see that in staples pulling back a bit, along with utilities a little bit soft. Still no real good up moves in the world's largest shipper, Maersk, but some good moves up in the banks led by JP Morgan, looking like ExxonMobil and Chevron maybe trying to find a bottom here. And we've got Apple just a few points away from all-time highs. Same deal with Microsoft, and NVDA starting to climb back up towards $500 a share. There's a look at Intel, still doing well in an uptrend, and some pretty good moves up in LVMH, the owner of Louis Vuitton, after having a bit of a weakness this last couple of months. Another move higher in Walgreens. Macy's still ripping up, and a little bit of a pullback for the telecoms, with some good moves in the regional banks and the big guys as well, holding on to their rallies. Okay, so there we have it. S&P 500. Like I said last week, I thought we'd hit new year-to-date highs this week. Happened in the last couple of hours of the week. We're quite elevated here. We're getting some bearish divergences. However, there's just a lot of good things for the bulls out there. Kind of the soft landing narrative being constantly reinforced. Low oil, really low volatility, and some good breadth out there across the market. We've got some good moves up in small caps and cyclicals, which is pretty good signs for the market. So if we do get a pullback, it should be a short and shallow one, unless we get a nasty surprise. Coming out of this low volatility environment, things could uncoil quite quickly, and we'll just have to see whether next week, I'd say we could lure in a lot of new bulls. Going to have big headlines of stocks breaking out to new year-to-date highs going across the wires next week. It's likely to lure a bit more people in, and we'll see whether it is a head fake bull trap and we do close the year back below 4,500. Other than that, by the looks of it, this market can't be stopped, and it looks like we're finishing the year out in that Goldilocks scenario. That's all for this week. Thanks very much for sticking with me and Click Capital. Truly appreciate all your support, and you're welcome to leave a comment. I do reply to every single one. Other than that, I wish you all a great weekend, and I'll see you again Tuesday night. Cheers.